Mm.
I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. Uh, a widely telegraphed trade and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2 year time frame, a 5 year time frame, or a 10 year time frame, I think gold goes much higher.
Investors who have seen gold and silver fluctuate over the past decade should pay attention to Rick Rule's latest comments because they present a simple arithmetic problem with huge ramifications. U.S. portfolios allocate a fraction of a percent to precious metals, but even a minor restoration to long-run averages would multiply demand. The market has a limited foundation. Small percentage allocation changes result in substantial flows into physical and precious metal stocks. Rick's bullish case rests on that asymmetry. Rick presents this opportunity in a macro context few investors can ignore. A continued US dollar depreciation, inflation, and poor real rates for long-term savers. Gold, silver, and their mining equities benefit from those pressures and structural underallocation in the long run. Smooth riding is not guaranteed. Quite contrary. As allocation dynamics reset, investors that accept volatility and plan on multi-year horizons may capture big upside. Equally crucial is understanding how this cycle is unfolding below headline prices. Bullion moves first and mining equities follow as operational margins rise and capital flows down the hierarchy. This cycle has expedited money flow to smaller producers and well-capitalized juniors, unlike previous bull markets. That acceleration affects where value is created and how fast market participants must act. The opportunity is no longer limited to majors. It's happening across all manufacturers and developers, and security selection is becoming increasingly important. The institutional discourse is now taking shape. High-profile allocators and renowned strategists who publicly consider double-digit gold holdings are redefining portfolio risk benchmarks. Even if a 20% allocation is unlikely, it reflects a shift in thinking among smart investors. Long-term asset allocations depend on intellectual shifts as much as price moves, since they influence the probability of future flows. Rick discusses volatility, money moving down the sector, and why huge investors prefer actual metal over paper exposure in this video. Practicalities on how premiums, distribution logistics, and market structure change with demand. Stay with us for a straightforward explanation of those mechanisms and what they entail for sector progression. Stay with us and ring the bell to avoid missing the complete breakdown.
I think that the underlying trend in gold is up, because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far, very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on.
Mm.
I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. The reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Ma's and Pa's, but foreign central banks. You'll notice that right after the move, pardon me, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said this would be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the US Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the US Treasury market. And as we've seen, really for at least 5 years, it has been disintermediation from US Treasuries into gold that has been responsible for the strength of gold. And that's continuing. Traditionally, gold bull markets follow a very predictable pattern. The metal moves first. And that was certainly the case this time. In prior interviews, I remember that some of your viewers were expressing frustration. 2022 is an example. The gold price was moving, but the gold stocks weren't. There was then a simple explanation. Foreign central banks were buying gold, and they don't buy gold stocks. So a market that had a bid went up, and a market that didn't went down. But there's a second reason that's much more traditional. It takes a while for an increase in the gold price to translate into an increase in gold producers' operating margins. We began to see that in 2024, and we saw it expressed in the market in 2025. In a typical gold bull market, it goes like this: gold to the best of the best, the Francos, the Wheatons, the Agnicos, to the best of the rest, the Newmonts, the Barricks, the Kinrosses, to the junior producer, the single asset producer, the developer, the explorer. What's changed this time is that the whole process of the money moving down market has accelerated. What happened in the prior bull markets in my lifetime is that the best of the best moved first, and they attracted market multiples, market capitalizations that were excessive relative to the rest of the sector. And so valuation arbitrage would take place. Guys like me who said, Newmont is cheap compared to Agnico, would move down into Newmont or down into Kinross. Or if they didn't, the guys with lower cost of capital, which is to say higher share prices, would take over the smaller guys. What's been unique about this is that the whole process is accelerated. We have gone from the best of the best, the Francos, the Wheatons, the Agnicos, all the way down, even to the advanced explorers. And we've seen that happen in 18 months. That cycle through the rest of my career has taken 4 years. And it's interesting. And I don't really know why it's happened. Perhaps it happened because that sector was so ludicrously oversold. Perhaps it happened because life of cycle bottoms in 2021 and 2022 were farcically low. And what we've seen in the juniors is a dead cat bounce. I'm not sure what we've seen, but what I have seen is that the best of the juniors have all taken advantage of these higher prices to come to market to raise capital. And for the best of the juniors, all of these capital raises have been substantially oversubscribed, which tells me that the money is present in this bull market, and the gold bull market is really, truly underway. It also tells me that investors need to be more careful. If the price of a company doubles without any change in the fundamental news around the company, it is, of course, half as attractive as it was before the price doubled. And so people need to pay attention to that. They are no longer in the easy money part of the cycle. The easy money part of the cycle is when companies go from being hated to being tolerated. And gold is certainly no longer a hated asset class.
The arithmetic of a persistent mismatch between supply and durable demand and declining dollar purchasing power argues for a markedly higher price trajectory over the medium to long term if your horizon is measured in years rather than days or months. This is the reason Rick is unwavering in his stance on the positioning of precious metals as a multi-year allocation decision rather than a short-term trade. The critical dynamic in the subsequent section of Rick's interview is the identity of the individual responsible for purchasing. The market undergoes a fundamental transformation when sovereigns, significant family offices, institutional allocators, and large pools of capital decide to prioritize physical metal, contracts for paper inventories. The balance between allocated storage, direct bullion ownership, and ETFs changes for investors as physical premiums broaden and delivery becomes a more salient part of price discovery. Comprehending the source of demand and the channels that are most likely to experience a compression. The initial distinction will be between being an early beneficiary of structural flows and being left to chase momentum after the fact.
Necessarily inconsistent philosophically.
Mm.
Oil prices often move as a consequence of broad economic trends. A soft economy on a global basis often stimulates quantitative easing, which is a fancy way of saying counterfeiting. The government response to a soft economy is often printing phony currency, which is good for gold. It doesn't always happen, but you bring up an interesting point in that it's likely that speculators and investors with a strong constitution need to begin to allocating substantially more resources in the oil space, which is hated or at least ignored. Um, Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold-oriented and gold equities-oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile. It was from J.P. Morgan Chase. And J.P. Morgan Chase said that the overall, the global allocation to precious metals and precious metals equities in the U.S. was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities.
Mm-hmm.
That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a 4-fold increase in demand.
Mm-hmm.
I have no idea what a
20%.
20% market share, which would be a 40-fold increase in the allocation, would do. I don't think it will occur, to be honest with you. I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%,
Mm.
and the interest on the US 10-year Treasury stays at 4.5%, what that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So that, pardon me, that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil.
Is that something you would do, Rick? Would you allocate 20% of your portfolio into gold?
If you look at my own portfolio now, first of all, somebody who looked at my portfolio would say I'd be a moron to own physical gold. Because as an example, I'm the largest shareholder of Sprott, a brand name for gold. My allocation to gold and gold equities is higher than 20%. But that's partially because of my economic prejudice and partially because I've spent 50 years coming to understand the gold bull market. For me, it's at once an investment, a speculation, and a vocation. I do all those things. I wouldn't encourage your audience, most of whom have lives, to be as over allocated to gold and natural resources as I am. But that's what I do. If you have a listener who owns a plumbing company, he or she focuses a lot of their life on running a plumbing company. In addition to being a philosophical adherent to gold, my plumbing company is a gold financial services business. So I'm way over allocated relative to the norm in precious metals and resources.
The analysis of Rick principles is clear. Precious metals are poised for a substantial re-rating. Allocation mathematics alone are persuasive, as U.S. portfolios possess only 0.5% of gold and silver. A fourfold increase in demand would be implied by even a return to the long-term average of 2%. The allure of metals as a defensive yet opportunistic allocation is undeniable in an era where inflation is eroding real purchasing power and bonds guarantee losses after adjusting for inflation. The mining sector's capital cascading rate is equally critical. Unlike previous cycles in which money was progressively transferred from bullion to the majors and subsequently to the juniors, this time capital has reached smaller producers and developers much more rapidly. Two things are indicated by that acceleration. Investor appetite is expanding, and valuations in specific sectors of the market are already fluctuating. Investors are required to exercise discipline in order to distinguish between companies that possess genuine operational leverage and those that are merely capitalizing on momentum. The combination of these dynamics suggests a rare asymmetry, with a limited downside for long-term holders and an outsized upside potential if institutional allocations continue to increase. This may be one of the most significant opportunities of the upcoming decade for investors who are able to endure volatility and concentrate on fundamentals. Please ensure that you subscribe and participate in the discussion in the comments if you found this dissection to be beneficial. In what manner are you positioning yourself for this metal cycle? Your perspectives contribute to the development of future discussions, and we will collaborate to monitor one of the most significant investment narratives of our era. I appreciate your attention.